You're listening to the Real Estate Sessions. I'm your host, Bill Risser. Listen in as I interview leaders in our industry, getting their stories and their journeys to the world of real estate. Hi, everybody. Bill Risser with another bonus episode of the Real Estate Sessions podcast. Yes, back-to-back weeks with bonus episodes. This one is an really elite lender panel in the Florida region, the West Coast. I've got Jane Floyd with NFM Lending up in Tampa. We've got Tammy Bolt with Homeowners Financial Group in St. Petersburg, and Julie Scott with Movement Mortgage down in Fort Myers. And they are going to share their knowledge about what's going on in the mortgage industry today through the pandemic, and really some important information about just overall, how does the mortgage industry work no matter what the market looks like or whatever the conditions are. I think it's a great takeaway for realtors to listen to this bonus episode and understand, to get a look inside at some of the inner workings of the lending industry. So let's get started. I have the numbers of years in total. We're not going to identify anyone in particular because I've learned my lesson over the years. But on this panel, we have 65 years of lending experience, 22 in broker work, 20 in bank work, so more specifically Bank of America, and 23 years in correspondent lending. I think that all adds up to 65. Yeah, it does. So we have a lot of knowledge here, and this is going to be, we're really going to try hard to not just ask a question and pass the mic. In fact, the goal here is for me to throw out a topic, and we all get to sit in and watch a lender mastermind in operation where they're just discussing it. So once we've discussed it, we'll throw another topic on the table. And I'm hoping you'll do the same thing. If you will throw questions into the chat, I'll definitely watch those and monitor that. And so let me start by introducing them. We'll start with Jane Floyd. Jane Floyd is with NFM Lending, and Jane has been in the business over 20 years. I've met Jane through our Tampa operation. She's based out of Tampa. Jane, welcome to the panel.
Thank you, Bill.
Now, I asked you all for a little bit of homework. I wanted you to bring with you one book to recommend to our viewers. So, Jane, what's your book?
Bill, can I please give two?
Sure, go ahead. It's starting early.
All right. I could not decide between two because you said 4 realtors. Right. So the top 2 books I recommend, one is Ninja Selling, which I know a lot of the agents are studying right now. And it's basically about by Larry Kindell, bringing value to your clients. And the other one, Bill, is People Equals Profits by Rick Ruby and Rita Casey. That is also about value, but basically teaches these agents how to make more money, save more money, and give more money. Playbooks of how to do real estate the right way.
See, next up, we'll go by years in the business. Next up, we're going to go down south to Fort Myers, and Julie Scott is joining us. Julie is with Movement Mortgage, and Julie was one of the 2 on the panel that spent some time with Bank of America. So got that banking background, which I think is so critical. Julie, welcome to the panel.
Thank you.
So homework. I think I was talking to you earlier. I think you stuck with the one book, right?
Yeah. I followed the rules. Thank you, Jane.
Okay.
But, usually I am a rule follower.
So the one book I would say is The One Thing by Gary Keller and Jay Papasan, and it's just simple truths behind crazy results. Just focus on the most important task in front of you. In this crazy world, we have so many things pulling our attention, and we all have a little ADD. So just really focusing on simple things will give you good results.
Yeah. Great book. I love that. And finally, we have Tammy Bolt. Tammy is with Homeowners Financial Group based out of Scottsdale, Arizona, which is where Tammy and I, we didn't really know it at the time. We're both in Scottsdale at the same time. Tammy is now running the operation in St. Petersburg, Florida. And Tammy is also someone who spent some time with Bank of America. So we've got, like I said, I love having a broker and Jane Floyd and the 2 bankers with that background. So we've really got a nice diverse panel. Tammy, how are you doing?
I'm doing good. Hopefully I'm not muted and I'm doing well.
Everything's perfect.
Technical difficulty. Sorry.
We're all good. And if I can get your book for the listeners.
Yes. It's called Atomic Habits by James Clear. It's just really an approachable way to look at your habits, your existing habits, and how to change them, which I think that during this time, we've all needed to change a lot of our habits. And it's just an easy read that just common sense things to be able to change some of those habits that we really need to change right now.
Wow. Yeah. And we have the opportunity to do that right now. That makes perfect sense. I love that. Cool. So let's get started. I want to throw out some topics, and I'll pick someone to start the conversation. But the first thing that comes to mind when we talk about the lending world and what we're going through today is I wonder what it was like when you knew this was going to be trouble. Like when was that, and what did it feel like at the beginning when we started this off? So Tammy, I'll let you kind of run with that one, and Jane and Julie jump in as you see fit.
It's kind of funny because for me personally, we had this huge rate drop at the end of February. And it's when we were just starting to hear the rumblings of this pandemic. And so we were getting phone calls and emails and clients wanting estimates. It was like drinking from a fire hose that was happening so fast. And just as fast, we're then facing, you've got to work from home now. Everybody needs to be safer at home and figure out how to do that as you're drinking through this fire hose. And then it suddenly changed to, the changes in the environment were causing lenders to need to change guidelines. And they were changing sometimes multiple times in a day and then reversing back to how they were. And so you have these pre-approvals out there and you just suddenly realize, I'm in a whole different world right now. And those lenders that we used to look as competition are now our allies because we all just want to take care of our clients. And so some of us weren't changing as fast as others. So we started to reach out to those lenders that we used to look at as competition. And now we're all just working together to make sure clients are taken care of. But again, it was that safer at home and everything just piling in all at once. So you realize that, wow, this is different.
Yeah, and I'll just say, I think all of us were in the market during the crash in 2008. So my initial response was, oh my goodness, do I have enough money in savings? Am I going to be able to survive? The mortgage, the real estate market is going to dry up. And that lasted about a week, and then we quickly realized this is not a housing crisis, and in fact, there's news today about how, mortgages are up 9% over last year. So we are definitely not seeing that. So after about a week, as long as I made sure, my family was safe, everything was good as far as that, then I kind of got excited because there's just so many opportunities out there. And, similar to 2008, I think it will weed out people, whether it's mortgage or real estate, that maybe shouldn't be in the business. But in general, my fears didn't last long. We're still funding loans. We're busier than ever. I'm sure Tammy and Jane can attest to that. And so that's my take on it.
Pretty much echo what Julie said. It was about a week period that I really thought the faucet was going to turn off. I remember going from, getting 15 leads a day to 1. And then I thought, okay, deep breath. But again, going through this in 08, 09, understanding the difference. And then just how fast, basically, all of us as correspondents dealt with on the back end that a lot of people didn't know what was going on with margin calls and warehouse lines, which like I remember way back and not understanding, like when I was a broker, not being able to fund a loan. And I couldn't get through that through my head. How could that possibly happen? But a warehouse line gets full, you can't move, you can't sell the loan because nobody was buying for that very short period, right? And so anyway, all of that got worked out very quickly. Government stepped in. And so again, mortgage apps are up. You look at the stats. We are all so busy right now with purchase business. We couldn't be happier.
You talked about the government stepping in. Boy, I've watched a lot of different panels, a lot of different lender presentations, and the word forbearance, which definitely has a foreboding tone to it, is something that was really needed by millions of Americans with unemployment ranging from 15 to 20%, depending where you are in the country. A lot of people needed this help, the ability to, let's call it, postpone mortgage payments. But it definitely comes at a cost. And for you, for the three of you in what you do for a living, I would love for you to talk about that. Explain, what realtors should know about forbearance. So when they're talking to consumers, they're speaking intelligently about it.
So Bill, and when I alluded to what happened is when they had to offer forbearance, right? And I think the stats, don't quote me exactly, but anybody could apply that thought they needed it. And I think only about 40% of the people that applied and got it executed on it and really took forbearance. However, so what happened originally, 7-8 weeks ago, let's say we all closed loans. Well, and then COVID happened so fast. These are people that may not even be making their first mortgage payment. And so that's what happened that made that an unsellable loan. Fast forward, under the CARES Act, the forbearance of a person right now could apply for up to 6 months of forbearance, whether they take it or not. However, if they need it, after 6 months, they can extend it for 12 months. And so how it's affecting us is that if a person is in forbearance, they're obviously not going to get a mortgage. However, if they applied for forbearance but never took it, it's still showing on the credit report, but it's not affecting their credit score, nor is it supposed to affect their credit score. Now, if they did, let's say they were furloughed after closing, took the forbearance, as long as they've made 3 payments, they can now get a mortgage. So meaning like people wanting to move now, people wanting to refinance. And then I think what's helping a lot of people, as opposed to the last time, everybody just went into short sale, right? I think we have a lot more equity in properties, but there's several ways if somebody is in forbearance and they cannot make the payments, the lenders will work around. Either, obviously, I always think it's kind of crazy. If you couldn't make the payments for 3 months, I don't know how you're going to catch up 3 months with just going back to work. But that is one option. Otherwise, they're working out payment plans, adding it and they're tailoring it to every client's personal situation. Or they're even modifying the loan. So if you have someone that absolutely just cannot, they can start making their payments, but they can't afford to make a higher payment. So they'll add that on to the end of the loan bill, and they can extend that loan for, say, 6 months. And in some cases, they will even talk about modifying. So you look at if from a lender's standpoint, if you have someone that can't even make their mortgage payment, rather than them going into short sale or foreclosure, the lender would rather work with them and literally modify it and may even reduce principal to that loan. So a lot going on, but the good news is that it's not supposed to affect credit. However, we as lenders, when we see it on the credit report, we have to prove that either they've been making payments or they never get it removed from the credit report.
To piggyback on that, so the important thing for realtors to know, and really anybody that has a loan, is, if you do decide to go into forbearance, it can affect your ability to refinance or buy. So I have some realtors concerned that they have a property listed and the new buyer is selling another home, to purchase that one. Well, if that loan was in forbearance, they may have an issue getting a mortgage to buy the new home. So just anybody, realtor, borrower, you just need to be very cautious of that. From what I haven't personally experienced this, but from what I've heard from several people, our servicers are just almost sometimes calling borrowers and basically, hey, let's put you in forbearance. There's nothing wrong with that. Not giving them all the information. I had a realtor call me. I did her personal loan, and she called me and she was very upset because she was going to do the forbearance thinking, no harm, no foul. And they would not send her anything in writing. And then she started researching it and realized that it's not necessarily a good thing, unless, of course, you absolutely cannot make your mortgage payment. Obviously, it's more important to feed your family than to make your mortgage payment. But if you can make your mortgage payment, do not go into forbearance. That, I think, is the most important point there.
Yeah.
When it first started happening, everybody would say, I pulled a credit report and it has the F word on it. So it became the F word. But again, it was one of those moving, changing, how do we handle this? Where before it was a dead stop. And we've learned now, okay, they've realized what they did by allowing that to happen. And now it's not such a bad F word, especially if somebody did either request or not request the forbearance, but it's showing up on their credit report. As long as they've continued to make those mortgage payments, we'll document that, we're fine, we can move forward. But before, literally, I'm sure that Jane and Julie will agree, it was that F word on there. Oh, stop.
I got to throw in Barry Habib's name right here. It seems like he might have had some play in this. Is that true? Like he went to either a collaborator or somebody, at the government and said, look, you understand what you're doing here, and we need to kind of correct this. Can any one of you kind of address that or talk about, first of all, how important this guy is to the industry? I think everyone on this webinar should probably start following his stuff. But who wants to take that one?
I'll just start it a little bit. First off, I'm a big Barry Habib fan. I kind of stumbled into the mortgage industry when I started in 2002. And that's how I learned the ins and outs, was by watching Barry Habib and reading his stuff every day. But yeah, he'll be the first to admit, he has opinions on people when they're making decisions without understanding the full impact they're having. And that's exactly what happened. But I'll defer over to Jane because I know that she knows a lot about it as well.
No, it's the truth. It's just those unintended consequences. They're trying to help, but not understanding. Yeah, and then what, right? So like with the servicer, with people not making their payments, but that servicer still has to make that payment to the investor. So that was a problem. But no, Barry, I've 29 years been a follower. There's nobody I hold in higher regards than Barry from an industry expert.
Yeah, Barry Habib, MBS Highway for the realtors that want to look it up. So
yeah, it's worth a follow. Yeah, I've started following his stuff, getting his emails. It's really a great takeaway for the group. Other conversations that are happening out there. Let's go like the National Real Estate Post. Frank and Brian. They're kind of crazy and they get a little opinionated, but they have some good information. Housing Wire is another really good resource that I'm sure all of you pay attention to. But a friend of mine, Jeff Chalmers, who's a lender in Boston, would send me these screenshots of these radical like ebbs and flows of like this chart. And I go, wow, what is that, over a year? He goes, no, Bill, that's the last 2 hours. I'm like, what? And so try to explain, because as agents, realtors are dealing with their biggest asset and all that emotion and all that, sometimes logic isn't as important as it should be. But you've got to be there doing the same thing, talking to these people. But behind you, these things are crazy stuff happening behind you that you have no control over. Talk about that process and how do you work through that?
As far as program changes and just the constant changes that are going on, that's one thing that I just want to make sure every realtor was aware of. If they have not, is it's constantly changing right now. Now, in my opinion, the news that I hear, it's not as bad as it comes out to be. Lenders are still lending. We still have programs for your standard buyer. But what has happened with all of this, because of the high unemployment and all the uncertainty of what's going on in the economy, are some of the high-risk loans have gone away or become much less available. So I know we'll talk later about jumbo, but some of your non-QM, so if somebody didn't fit into your standard, government-insured agency loan, then some of those programs have become harder to come by, like let's say your bank statement loans. But and every lender is going to be a little bit different with this. So every lender has set kind of their own criteria. But what I've found in general is most lenders have raised their minimum credit score. For us, it's 620. I'm sure it's similar for Jane and Tammy, where we used to be able to go down to 580. That's temporarily gone away, but it's only temporary. And I tell people, talk to your lender. If you have some credit issues, they'll work you through it. And then in a month, 6 months, however long it takes, when the lower credit scores come back, assuming you're still in the lower credit score category, you'll be ready to buy something. For us, construction loans went away temporarily. Also, the down payment assistance. So we're still lending, and we're still going to talk to the borrowers and kind of guide them on what they need to do. But just, it's a little bit different. Some of those, like I said, the higher risk loans have gone away temporarily.
For me, and I think for both Tammy and Julie, so that sounds like a lot, everything that Julie said. Oh my gosh, all of that's gone. But those, quote, non-QM programs, for the majority of lenders, that is a small portion of what we do. So the conventional, the govies, even though the credit score requirements are higher, they're still out there. The like rehab loans, literally, and so like with a rehab loan, we had one like cleared to close. Like I've been working with this past client, and when you say on a day-to-day basis, all of a sudden you get an email, boom, we're not doing them anymore, and we're not even the investor, we're not even closing what's in the pipe. That caused a lot of stress. Fortunately for my company, and I'm sure Tammy and Julie's, we honored that. It cost us a lot of money, but we closed that loan because there was no buyer for that loan. So all of those bank statement, all of those loans, to the best of my knowledge, are gone. Government loans, same. Used to be able to go down to a 580. Now, actually, there are brokers out there, which I don't know about you guys, but we signed up to just to have that outlet for our few borrowers to be able to do those loans. Again, every one of us are at hitting records with closings, and I mean, and applications coming in, and it's all purchases. So that was just such a small portion. I don't know if you wanted to jump into the jumbo right now, or if that was a whole nother topic.
That's one thing that dried up really fast at the beginning, and a lot of it is because of banks are the type of investor that do jumbo loans because they're not sold to Fannie, Freddie, FHA, VA. So they're a little bit different. And there are guidelines surrounding that. It takes up liquidity reserves that a bank has to have. And so they dried up because everybody reacted really quickly. They're opening back up. They didn't go away completely, but you did see the availability for them to drop drastically. But what you are seeing is some of these investors that were great, like I loved Redwood Trust. We processed, underwrite, closed, and funded for them. I mean, they were great. Unfortunately, they may be permanently gone. They got hit really hard. And the gentleman who runs our capital markets is very close with them. And he gets emotional when he talks about it, actually. So, but there are other investors that are coming in to take up some of that market shares. There are some small banks that I specifically know of in Arizona that actually took the template from somebody like Redwood Trust. So they didn't have to recreate those guidelines because it was a great product. It's just that Redwood kind of got caught in a bad timing. So they're definitely coming back. They're not where they were. It does remind me of back in the 2008 timeframe where there was a period of time where jumbo rates were better than conforming, and then it reversed. And that's just, we saw jumbo rates were better than conforming, and now they've reversed. So, but, so jumbos are coming back. Not everyone has everything, but it's one of those things that we're in the market in that we refer out to who we know can do it. But also there's those piggyback loans are still there too. Those that that's still the best rate, and they can do that piggyback funding home equity line of credit for that second to keep it below that jumbo. But they're coming back. It was one of those that zigzag coming back and forth. It's any given day it changes.
As an ex-closer, Chicago Title and Phoenix, you mean 2 loan packages at a closing again? Oh no! All right, go ahead.
Yeah.
Julie, what's your take on jumbos? I mean, you're in a market, obviously Fort Myers, right on the beach. So
yeah, I mean, honestly, I'm not a huge in the jumbo market, okay. But just to kind of say what Tammy was saying, this number one has brought lenders together. So if I can't do something, I'm going to find somebody that can do it. It's not all about just making a commission on it. It's taking care of the customer. So that's a good thing. And I know realtors are doing the same thing. Also, the news isn't that bad. Once again, like Tammy said, a program goes away. Well, somebody else comes out with it. Or maybe a program was gone for a week, or maybe like with some of the down payment assistance, we still can't do those, but they will be back. And in the meantime, we just figure out how to make it work. And that's the key with working with a good lender is they're going to do the right thing for the customer, figure out how it works. And, if the customer's not ready to buy now, then we'll work with them to make sure they're ready in the future. So there's a lot of opportunity out there. And as long as people stay positive and just are working with the right partners, there's a lot of opportunity. One other thing, Bill, and I was curious with Tammy and Jane, since we're all in different markets, when this did happen, my initial thought was, oh my goodness, all my borrowers are going to lose their jobs. Nobody's going to be able to qualify. And what I found is really, I've only had a few loans affected by it because here in Southwest Florida, we're such a huge second home market where we have a lot of retirees. So in fact, it's only increased business because I'm finding people are like, I'm not taking my money out of the market right now. I'm going to take advantage of these low interest rates for, people that are retired or maybe would just normally pay cash. So I have not seen a lot of borrowers not be able to buy that could have before. And I was just curious if Jane and Tammy have seen the same thing.
What I'm seeing, especially this past 2 weeks, are those people that we pre-approved in January and February. They've all just come out of the woodworks. It's like they were doing kind of what we all felt at first, kind of cocooning in and not doing anything. And now they're like, I'm buying. And so a lot of activity for those that are taking advantage of the good rates, and they know that life's going to go on and they're going to be fine.
Are you getting phone calls from people up north who are like, where it really hit hard and they're going, you know what? I know we've been vacationing a lot down south. Let's think about making that more permanent, maybe a little earlier than we thought. I would think that that's a part of what your booming business is.
I think between up north, and then also, Bill, coupled with, it's very interesting, the whole remote. Some companies are so old school. I want to touch, feel, see everybody every day. And I'm realizing how much more efficient we are. And so I'm hearing that from the DC area, literally is like, there's no reason I can do my job. I've had to prove it to my company. So I think coupled with those two up north and then being able to work remote where we live, who doesn't want to live here? So yeah, I'm seeing a lot of that, Bill.
Yeah, that's huge. And like right before this call, I just got off the phone with a ICU nurse in New York. I think she's in upstate, but it's terrible there. She's like, I have got to get out of New York. I'm moving to Florida as soon as I can. So I'm seeing, we've always had a lot of people from the north, especially the Northeast, want to move here, but I'm seeing it more than ever now. And just like Jane said, more and more people are working remotely, so they can live anywhere. It's wonderful. And why not choose Florida?
Right.
Or downtown St. Pete, right, Tammy?
That's right. That's right. Exactly. That is something that we're starting to see more of too, as guidelines change, and maybe we're making an exception on something to maybe do a little bit lower credit score than we are comfortable with. It'll go to something called committee, and that's something they look at. They look at, okay, where do they work? Are they working in a job that could be performed remotely? Just to kind of boost up what it is they do for a living. It's that comfort cushion.
Is that just since the pandemic started, or was that around before that?
Oh, no, definitely.
Wow, that's great. Because I've been in the business 20 years, and it's embarrassing to say, I'm going to assume other people are like me when it comes to what you all do. I know that there's bankers and brokers and correspondent lenders. Can someone explain to all of us in layman's terms what that means, what each one does, and what the differences are, and maybe how they're similar? Who wants to take that one?
Well, I could start it in my very, very layman's terms, because embarrassingly enough, I'll admit it, and even as recent as 2013, I didn't know the difference. I'd only ever worked in a bank. I'd been recruited by a correspondent lender, but I didn't know what that meant. And so I confided in a friend because I was so embarrassed, and how she explained it to me. And it makes still perfect sense to me. A bank, they are, they're great, but they're very cookie cutter. They sell the Fannie, Freddie, VA, FHA, just like everybody else. Then there's correspondent lender. We are, which I am now, but I was a bank, correspondent lender. We sell to Fannie, Freddie, VA, FHA, but we're very much more relationship based. We're more fluid. And, we, just like a bank, we process, underwrite, fund, close our own loans. A broker, which I've never been a broker, so I can only speak to what, the explanation is, they have many options to choose from, much like a correspondent, because we can broker as well, but they don't process, underwrite, fund, and close their own loans. They're kind of relying on a third party to do that for them. But Jane can answer that piece much better than I can, the broker side.
Actually, Tammy, you did a great job explaining. I think one of the things and I've never been a bank, I was a broker for 22 and a half years, and I've just been a correspondent for 7 now. All we do is loans, home loans. That's it. We don't do car loans. We don't do checking accounts. We don't do any of that. So, from a service and a control standpoint, to me, it's the best. Now, as a broker, you don't know what you don't know, right? Because it's all I knew, and it was all I thought I'd ever know until I came to the other side. Even though I did process my own loans, everything else, every loan was outsourced, right? So for me, having the ability to talk straight to the underwriter and paint that picture, like, I need you to do this loan, I need you to understand it, and here's why, that, and just the level of communication and not having that, all those levels, right? So it's me, and then boom, I need something done. Whereas being a broker, I'd have to go through an account rep, then would have to go to a underwriter, and then a head underwriter. So you know what? It's not. For me, correspondent's the best. But I've never been on the banking side. And I think all my agents I have agents that have been with me for 25, and some of them since I've been in business. And I think they would tell you the same thing, because it's all about, everything we do is about adding value to our realtor partners, and then being able to service the clients. And what I've been able to pull off being a correspondent, I was never able to do as a broker. But Julie has been, I think, with Bank of America, right, Julie? So
yeah. No, you said it perfect. I've never actually been a broker, but of course, working as a correspondent, we can broker out if we have kind of a funky deal. And just like you said, as a broker, you just do not have the control. You're relying on another lender, and it's a little scary. It almost goes into a black hole, and you're not sure what's going to happen, unless, of course, you have a great relationship and you've worked with that lender for many, many, many years. But as a banker, because I can speak about that as Tammy did, the key is a banker, a bank, mortgage is only a small segment of their business. And, prior to the crash in 2008, I think everybody worked at a bank, the loan office, there were tons of loan officers at banks. Then after the crash, Bank of America, we can speak for that. They had so many lawsuits, so much red tape, and they really retracted, and almost you felt as if they didn't want to do loans. And then today, it's kind of the same thing with many of these banks. You walk in and you're either calling somebody on an 800 number, or you're dealing with a personal banker that opens checking accounts and really does not know what a debt to income ratio is. So, that's why, yay, correspondent lenders, right?
Not a full education, Bill.
That's awesome. Well, look, I love that the relationship word came out, right? That you felt like at a bank, it was follow the rules. Don't even think about coloring outside the lines, because that's not going to work. Whereas now all three of you have this ability to, as you said it, Jane, paint a picture and say, look, this is why this will work. I love that. I think that's great. Now, we have a couple of questions coming in, so I'm going to hold them till the end. But if you've got questions for these three ladies, please put them in the chat or put them in the Q&A, and we'll get to them. Look, I was saving this question kind of for the end, because there was, some rough news that we had to go through with forbearance and things. But I love the fact that somebody who got into the housing market in, say, 2011 or 12, right? What's the highest interest rate they've seen in their career as a homeowner, home buyer? Is it like 4 or 5 at the highest, like crazy high? And now it's even lower. So talk about rates and what's going on. And what do you see? Do we see these continuing on? I know it's really tough to pull out crystal balls on this kind of stuff, but I'd love your input because you're all dialed into this is, for this audience.
Everybody anticipates they're going to stay low. Again, wow. Barry Habib, he listened to him and what he is hearing and what he is seeing. Definitely, he thinks they're going to stay low.
Yeah, I mean, when I got in the business, which was 1999, every morning, and I'm sure you, Jane at least, and probably Tammy can relate, we would get our rate sheet faxed over. It wasn't on the computer, and it was 7.5, 7.5, 7.5. It was always 7.5. And actually, it really didn't change much. Not like today. They really do change quite a bit, especially on the government loans, FHA and VA. But yeah, rates are phenomenal. I mean, if somebody's got good credit and they're buying conventional, they're going to be probably in the low 3% on a 30-year. I mean, I think got somebody today that wants to lock in about 3%. So of course, it all depends on the buyer's situation and the type of loan, because government loans, FHA and VA, are going to be a little bit different. But yeah, rates are phenomenal. So like I mentioned earlier, people are taking advantage of that. I mean, you can't get much lower than 3% or the low 3%. And so, we're not doing a ton of refinances right now, but, we are helping people consolidate debt. That's a huge thing. So, anything we can do to help better their lives. I mean, I've got some people, I'm consolidating some, high interest credit cards and things like that. So, yeah, I mean, realtors should definitely be using that if they've got buyers on the fence. I mean, the difference in their payment, if they were buying, say, a $300,000 house between a 3% rate and a 4.5% rate is going to be pretty significant. So just definitely reach out to your buyers and make sure they are aware of those low interest rates.
Somebody just posted that they got their first loan at 12.5%, and it brought back. I personally got my first loan in 1981. I was still going to University of South Florida, and it was a 2-1 buy down at 12.5%. Yeah. 2-1 buy down. So obviously everything that Julie just said, and rates are predicted to stay low. What's kind of neat that I feel like, because I think all of us really, we look at ourselves more as, advisors in the industry, right? Like really looking at the client scenario. And when we can take someone out of some debt, that they may, and teach them how, hey, look at cash flow. Let's get you out of some of this debt that you may never be able to. It's just so rewarding. And I also I work with several financial advisors, and if you're getting loans like in the 3% range, why would you want to pay cash? Why would you want to pay cash? At least take out some sort of mortgage and create your own arbitrage, right? So it's really fun right now. It's really fun.
A couple of questions coming in. Let's see. Have lender guidelines been adjusted regarding the property since COVID-19?
The question is, are there the collateral piece? Is there any?
Yeah.
I haven't seen any restrictions.
Also, another question. So what are the rates today? We know it's just today, and we'll just go on convention.
Girls, don't we love that question? We love that question.
Yeah. I was going to say, I'll help it out.
We're going to ask you several questions to answer that question, Bill.
Let's see if I can do this. What are the rates today for 720 credit score, 20% down conventional?
What's your loan amount? What's your lock-in period?
It's 300,000 and a 30-day lock, and I need a 30-year fixed price and a 15-year fixed rate. What are the two rates? You just your best guess.
Right around, we're hovering everybody, I think, right about 3.125 with 0 points. If you want to pay, 0.2, you may get that 3%. But there's so many other variables, even than what you just named. Is it a condo? Is it a primary residence? Is it a second home? I mean, there's so many variations in there that, I always share the story that I had a client that once came in and wore a button and it said, I'm more than my FICO score. And I was really new in the industry when he wore that. And so now I look at myself and I think, I'm so much more than my interest rate. Like you were saying, we're advisors. We provide service. We're more than just an interest rate.
Bill, I'm so glad you asked that question. Perfect though, because that's the education, like why, and so why is the interest rate the most important thing? And Barry's got a great graph that we show people, like, oh, let me just show you in the past 30 days, where these rates have been, because at the end of the day, if you're not on contract right this minute and ready to lock in, we need to look at the whole picture. So that's the range.
Yeah. That's the tough part. I know. I remember buying homes where it's there. It is this, I think I should lock. I think I should lock. That's such a conundrum for the consumer, right? Because of course they want the best of every world. If it goes down, it's all good, right? I'll get that one too. And whatever, but yeah, exactly. Is it hard for a self-employed person today to get a loan in this market, or are they okay right now?
It is, with the IRS being shut down. There are with self-employed now, with the IRS still being partially shut down, depending on whether they have 2 years, whether they've filed 19, which everybody knows that. Most people know that's been extended, if we need those transcripts. So guidelines as far as qualifying haven't changed, but due to the IRS, and then also proving that depending on back to like what we talked to a little bit ago, depending on what you do for a living, right? Like for instance, I closed a nail tech like 30 days ago, but I had to prove by bank statements that she still had, even though she wasn't non-essential, they want to see you've still got income coming in. So guidelines haven't changed, but there's just it's that whole risk, because again, they don't want to take, just because if I do have 19 tax returns and they qualify, but if they haven't made a penny since COVID started, that's a loan that's high risk to go into forbearance and then spiral down to everything that we talked about.
Wow. As I sit here and listen to the three of you talk, I talk to realtors a lot, right? And every transaction is different. Like the house is different. The story of the consumer is different, their family and their needs and all these things. And I think what happens when we think about lenders is, oh, you're all doing the same thing. You all got the same stuff. It's all the same. But every single transaction is its own thing. Nothing ever works perfectly into a platform. Even if the person's just going to be an FHA buyer and it's real standard, their story is going to change how you have to interact and make that deal work. Correct?
Correct.
Yeah. So that's our big takeaway for today, is to understand that, it's every single transaction, every single person you serve and help is different.
And that they need Julie and Tammy and me, and not online, to do that for them. Click button, get mortgage. No, it's just not that easy.
All right. I love that. I love asking this question of anybody that I'm interviewing, whether it's on a webinar like this or my podcast. And each one of you gets to answer this question. And I'll let you whoever starts talking first gets to go first. But what one piece of advice would you give an agent today, where we're at, in what obviously things can change, but what today, what piece of advice would you give to an agent?
I will tell you, and I said this about 4 times yesterday, anticipate movement and change in underwriting guidelines. And when you're working with those pre-approved borrowers, make sure that they have talked to their lender recently, maybe like today or yesterday, because things are changing that quickly. So maybe somebody that we did a pre-approval for in January and they had that 580 credit score, we can't help them now. And they need to understand that it's not just Tammy Bold at Homeowners Financial Group that can't help them, but it's also Julie Scott at Movement Mortgage, where before people would hop around, I'll eventually find somebody, but that could change. Our capital markets guy thinks that by August, we are going to be back in that mode where that's going to be okay again. But if you're looking today, right now, my advice to any realtor is ask their buyer, when did you last speak to your lender?
Yeah, what I would say, not necessarily mortgage related, but communicate with your database. Obviously, more and more people are at home, so they have more time to be on the internet. If they are considering buying a home, they may be moving around on Zillow or some of these other databases, and there's more opportunity for them to stray from you. And obviously we don't want that to happen. So just stay in front of your database, and since they're home also, they're feeling more isolated. They would love to get a call from their realtor just to check up on them. Maybe not even as a sales call, but just to call them and check up on them. But also, like Tammy said, if they were pre-approved, hey, are you still looking? Make sure you give your lender a call and make sure there's no issues with your pre-approval today. So just stay in touch with your database.
Tammy, I love what you said. And I also think with we're constantly, I think all three of us have the majority of our business is past clients and mostly realtors that we have relationships with, but some newer agents and maybe not as confident in themselves. In light of everything that is going on, you may have a borrower and an agent will say, hey, well, just go shop it. Shop that rate online. We just told you how great rates are. I don't care, in any good or service, you're always going to find something cheaper if you search long enough. So to save a couple $100 when you have a relationship like this, it's I don't know about you guys, but the save deals we get because somebody left us for a penny, and then they come back because they don't close on time. We have to be in relationships for the client. And then Julie, 100%. Agents, it kills me. I am big on, I do 30-day calls, 90-day calls, 1-year call. I work my database, and it's amazing how many agents, that's your gold mine. These are people that loved you. And all you have to do is work your database consistently by, now, of course, videos, handwritten notes, having events, and the sky's the limit with success.
I love those. That's awesome. That's great. I can't thank all three of you enough for doing this, taking time out of your day, getting on the prep call, doing all those things you had to do to join us and really, I think, help a bunch of people understand what you're doing, what it means, and what it's looked like in the last few months. Thank you all so much for your time.
Wow, we're honored. Thank you.
Thank you.
Thank you.
Thank you for listening to the Real Estate Sessions podcast. To leave a review or rating, go to ratethispodcast.com/RE sessions. You can also subscribe to the podcast at your favorite podcast listening app. Finally, you can go to therealestatesessions.com and subscribe to our email newsletter and be notified whenever a new episode is released.